Benedikt, it's a pleasure to actually see you
Likewise.
in person. Welcome to COP. I said to you earlier off camera, you're one of my heroes. I want to tell you that on camera as well. No, seriously, one of the most incredibly intelligent people in this market. But okay, enough adulation.
I start drooling a lot.
I'm the one for you. So you're an investor in carbon markets. Give us a little bit of background about your work, but then I want to get your perspective around this market that is evolving, and especially the thing that's been missing this year, which is demand.
Okay.
What was yours, sir?
Yeah. So set the stage a little bit. So we're an investor into carbon projects, or rather a buyer. So we purchase emission reduction contracts, longer term, with a view to bring finance to the projects and a return to investors. And the view is that if only emitters are actually buying, they try to keep the cost down.
Yes.
Naturally. And so you're talking to people who try to minimize the expense. If you talk to investors, you're trying to people who have a lot of money and trying to maximize the investment.
Maximize returns.
And so if you want to bring horsepower onto the road, you need to talk to the guys who have the horsepower. Mm-hmm. And so that's what we're trying to do. And part of the, let's say, the narrative that we see playing out after having been in the market for 20 years, and we have seen this develop these cycles a few times. It's another cycle with a few implications. One is we don't call it the voluntary market, really, we call it the project-based market, because voluntary is a very downstream focused view on the buy side, when in reality the product is upstream, right? Mm-hmm. A carbon credit can be used for tax purposes, imported for a compliance scheme, used in retail, for corporates. It can have all sorts of use. It'd be an Article 6.2. It's all project-based, and so calling it voluntary is really very restrictive. So
what's they have in common is that it's all baseline in credit.
It's all baseline in credit, and it's all ex-post success verification. Right?
Yes,
so a carbon credit
finance with the verification.
So a carbon credit is nothing else than a climate impact success indicator.
Yes.
If it's done well, right? And if you would call it, and it's getting to it, if you would call it a climate success indicator unit, who wouldn't want that?
CSI, I love it.
Right? So we don't need more climate success indicator units. No, we need more climate success. And I think one of the topics that we're facing right now is that semantically an offset and offsetting is, in my view, way too broad and confusing. So an offset traditionally was used as a zero-sum game exchange. So you reduce something here, in exchange you're allowed to emit more. And a lot of people hated this already from the CDM times. And said it's a zero-sum game, there's no net benefit for the environment. However, if you're an emitter, for example, in the EU ETS, if you're hosting Arsenal in the EU ETS, and you would buy carbon credits, it's not like an exchange you can emit more. No, the regulator wouldn't even see the carbon credits. It would be purely additional financing of climate action. And so, but it's also still called an offset.
Yeah.
Right? And so, and what we're talking about is still offsetting. But it's the good part of offsetting. So I would differentiate between people who use offsetting as an excuse to do nothing and others who go beyond what they're already doing. And the beyond part is very good and the excuse is bad, and they're both called offsetting and offsets. And that's very confusing.
That is very confusing.
So we have to get away from kind of labeling everything as a bad offset. We have to differentiate when is an offset a good use or not. And VCMI and others are allowed doing a very good job doing this.
Yes.
But let me get to the demand side. So why do we see this grow? Currently, and implied in the word voluntary market, voluntary buyers have been in the past corporates, and who within the corporates has been the marketing ESG department who had a certain budget, and if you buy the narrative we're carbon neutral out of a marketing budget, then your decision is basically competing with other decisions of marketing. So in other words, if carbon credits would be too expensive, you'd say, you know what, I'm not going to buy that many carbon credits. I take out an advertising on that page or run a news. I have different ways
Different incentives.
of building a brand.
Yes.
And you're competing within this bucket of marketing.
And it becomes discretionary in terms of spending.
Right? And
Absolutely.
and you have kind of a glass ceiling because you try to minimize costs. At some point you say,
Always.
It's not worth spending $10 million if we can get marketing value for $1 million somewhere else.
I've had those very conversations with
And
clients over decades.
And so you have to wonder, what is the value for the buyer of a carbon credit? People say, well, we need higher price credits, but then we run into the problem that higher prices is not competitive with other means. So our view is that the value of a carbon credit is the relative value. For example, if I have to pay an 80 euro tax and I cannot pay it if I have a carbon credit, then intrinsic value is anything up to 79 euros.
Exactly. Any discount from that base.
Exactly. Right?
Or from that ceiling.
And so 60 euros in that respect is not a high price.
It's actually a steep discount.
It's saving me 20.
Exactly.
Right? And so, and similarly, this is what happened with CERs in the EU system. I bought a CER because I could swap it out and save money. It's not that I'm saving the world. It was really the big demand came from financial players who said, if I buy this, I make this much money. It's a profit-driven demand. And to unlock that, that's in the hand of regulators. To say, and there's two ways to do it. You can either incentivize and saying, you have to pay a tax, but here's your get out of jail carbon credit. Or they can say, you said you're going to fulfill a 2030 target. Here's a penalty if you say something
If
you don't.
now there's a deterrent.
And so the carbon credit is the get out of jail card reputationally to not adhere to your target. So there must be some value to it.
Yes.
Right?
And it's a very rational view.
And if there's value, not just marketing value, but real monetary value, then that's not marketing expertise anymore. So we need to hedge that, right? So in other words, if, for example, you have an 80 euro carbon tax and you can get out of jail with the carbon credit, you save money, you won't today lock in eligible carbon credits for the next 5 years during the tax period because you're saving 20. But that also means that every time you don't get the carbon credit, you lose the $20 upside. So you need to hedge that today. Right? How do you do this? Portfolio management, you have to go to somebody, you go to a bank and say, can you promise me delivery of my get out of jail credits? And that really incentivizes demand.
Yeah.
Right? On the long run.
On the long curve, yeah.
And this is then not a marketing expertise anymore, it goes to treasury or to trading.
And risk.
And risk management, because it's a real financial risk at stake. And the trader will say, I don't know much about the type of credit, but I need something that's good enough.
Yeah.
So let me go to an expert and just contract good enough credits for the next 5 years. And then you have an aggregation where you have experts managing portfolios that they can backfill, not project by project. I never understood why companies who have a European operation would take emerging market risk in an area they're not good at, with a technology they're not familiar with a product they don't really need, just because they have control of due diligence.
And sometimes even go one step further in the lunacy, which is I want to go further upstream and actually invest and own in the underlying asset. I'm an airline and I want to now become a land, work on land rights and own this asset at the foundational, like the ground level.
Exactly.
That's not very,
or you're a tech company, or you're whatever, a car rental. The only reason why you would do that is that you don't trust what you get and you want to control it for reputational reasons, or you buy the narrative, you can do the photos.
And you can do that for a very small percentage of the portfolio, like the hero projects. But risk management and portfolio management 101 is that diversification is part of that strategy.
That's what I'm getting at is if it's a voluntary credit with no strings attached, if you don't get delivery, bad luck.
Yeah. But on the compliance side,
if every credit that you don't get delivered exposes you to the risk, for example, if you have financial penalty and the regulator says you pay penalty, if you have non-delivery, you have market risk, because then you have to go out and buy an eligible credit. And today you don't know what this eligible credit is worth in 3 years' time. Right? And so just back of the envelope, for example, every company who has a 2030 target that's beyond what they can physically achieve is short carbon credits.
They're short. Yep. They're short.
The minute they say we want to do minus 40% in 2030 and they can't do this, they're short carbon credits.
And that was why we had this meteoric rise in 2021 and 2020, because the hedge funds recognized this short position and they said, corporates are short, they're making these net zero pledges, and we are willing to bet essentially that they're unable to do so without carbon credits, and we started to see this rush.
But the genesis was more that you had Corsair, right?
Yeah,
the air carbon exchange was air, and the Corsair contract, the deal. So the
don't forget the aviation carbon exchange.
The aviation carbon exchange. But what I mean is, the traders at the time saw that there's real semi-compliance demand, right? And that was a traded product that you need hedge. The voluntary market I'm always surprised when people, when show me decks for investment and say, here, I want to set up, an exchange for voluntary credits. And I'm like, why do people trade on this? They say, well, look at the ETS, carbon credits trade. I said, yeah, but the ETS is burning carbon credits every day as they produce power. Meanwhile, a voluntary credit you submit once a year and there's no strings you don't. Why would they trade on a daily basis unless you have some hedging requirements and some balancing requirements, which for voluntary you don't have? If you're Corsia and you burn kerosene and you have to offset part of this with credits, yeah, you need to balance the books at least regularly, not just year end. But if it's a pure marketing thing, you don't have to balance your marketing exposure on a daily, weekly, or monthly basis. So where does the turnover, where does the price information, where does trading liquidity come from in a purely voluntary market? Right? I think that's hard.
Yeah, that's why when I was at Expensive, we launched first with the geo contract, right? In reflection of the demand coming and the demand signal coming from the aviation industry. So that
precisely, and that now shifted, right? There was no more kind of compliance, actual burn rate demand. It's back to the marketing
in the pilot
department.
phase, certainly, but in the long term.
But still, airlines are also traders.
Yes.
Right? And so what I mean is, as a regulator, if you wanted to create demand, you have to use a carrot or a stick, and then you can unlock this.
Yes.
And so we as a company, we're pretty convinced that eventually this has to come just because you have to tackle the system somehow, you have to unlock it. And then it's a matter of the quality, of course, right? And there's all sorts of initiatives, a lot of them announced at the COP, of streamline and make the quality, the high integrity measurable. But once that is, you can have all the 6-4 framework in the world, you can have the best quality credits if nobody's buying them, whereas as before, right? Of course, higher quality could enable daring companies again to be voluntary, but I think the voluntary bit is one part, but I think we need the semi-compliance bit, and that could be a voluntary commitment that
we're already seeing that, Benedikt, right? So we're seeing this fungibility of these instruments, and our friend and the carbon market influencer, Rich Gilmore, right? He's coined this term, the verified carbon market.
Exactly.
And I'm really in support of this kind of nomenclature change, because voluntary seems to have a stigma because of what you said. It's the driver. The driver is it's marketing and kind of PR, and so ultimately it's discretionary spend. By replacing that with the verification component, it's that credit. We're talking about a credit here, and it can be utilized not only to substantiate voluntary claims, like in the VCM, and as per VCMI and ICVCM, etc., but also the fungibility into compliance systems. Corsia, you've mentioned, but there's other systems, like in Singapore, we have a carbon tax, and in lieu of paying that carbon tax, you can actually submit and surrender carbon offsets. So as you said, now you have a ceiling, right, with regards to that price. It steps up over time, and you have a flow of offsets in lieu of paying that tax. It starts off with some percentages, it's 5% at the moment, and it can ratchet up over time as it becomes harder and harder to abate, and it becomes effectively a pressure release valve in terms of the velocity side.
Exactly.
So now you've got that stick and a carrot, which is
well, and you're bringing up an important aspect, which is timing, right? Time. Marketing departments have usually, with exceptions, from a couple of very big shops, but they usually have annually rolling budgets.
Yep.
Right?
And use it or lose it.
And exactly. And but from a high or carbon projects with high additionality means the only product is carbon.
Yeah.
So how do you get a carbon project off the ground whose only product is carbon, which has an upfront investment, if you don't know what my carbon revenues are going to be in the future?
Yeah.
So they, just like any renewable energy project that needs PPA long term in order to build it, they would need a carbon PPA, which is we call the is to go and say, okay, you de-risk it. I know that over the next 5 or 10 years, you're going to earn X amount minimum. So that's actually viable. So it's not like 0 or 100. It's actually, a stream. How is the marketing department going to give them that certainty if they're basically buying on a running basis? That's also why, in my view, sort of prior to, 2000, let's say 20 or 19, when you had kind of the voluntary market with 60 million tons a year for 5 years, peanuts. This was projects that could live off annual revenues, low risk, low price, and then people complain, why don't we have higher quality projects? Because nobody was paying for them. And so I think if you align a hedge horizon, where people want 5 years of credits, that's very much in alignment with kind of project finance.
Yes.
And this is
now
how
you can actually get debt against that as well. Yeah.
And another way would be if you had for 6.4, if you would have government tenders, arguably the renewable energy revolution was really kicked off by the German government offering 20-year feed-in or off-take agreements for wind farms that nobody had built until that day.
Yes.
Right? And they said, I'll buy that electricity way above market price for 20 years, AAA counterparty. And everybody say, okay, cool. We're left with operational risk that we can handle.
Yeah, that we can price, that we can handle.
So if you would have 6.4...
I don't want to kind of skip over that. That is an incredible policy example that really helped to transform. So I want to wind back the clock. So that's, 2005?
Yeah, around that
time frame. So I'm kind of go back into my mental Rolodex. 2007, I think the price of, let's look at photovoltaics. So I can remember that one. I think the price per megawatt hour was like, I think it was like $800 a megawatt hour. Crazy. And now it's like $2. Right? So it's like Swanson's curve. Basically, it's like the inverse, like Moore's law, essentially, and that focuses on this. And then basically, those signals were so symmetry in getting that initial inertia, and then you started to see scale. Spain, then China entering the fray, United States, etc. And it just...
China was a reaction onto the German and then European demand.
Because they saw that demand, so then they said, well, we can do the manufacturing, and now watch this. We will do that industrialization of this.
But all of this worked because they de-risked in the future. And nobody, in the carbon market, which private entity can take policy risk? You can't, you're like the play ball that the regulators are playing around. If the EIB, the German government, World Bank would go out and we do a tender for Article 6.2, 6.4. Here's our whitelist of eligible projects, and we'll buy 10 years of carbon credits from this, a little bit what Click is doing. This will unlock, first off, everybody will sharpen the pencil and calculate and bid into this tender. And then by doing this, you already get the education infrastructure within the banks, within the developers saying, okay, we didn't win the tender, but now we did the homework, so let's see if we can get somebody else stepping in, right?
Yeah, and now you can get the private sector funds coming in, so funds like yourselves pop up, and it's a vibrant ecosystem. Yeah. But you need that signal.
You need the signal, and you need somebody to take that level of risk, right? The level of risk, and this is, and maybe you're probably aware of it, but even 6.4 as an Achilles heel, that even if you have a letter of authorization, it has to be then represented in the biennial reports, and then it has to still be officially deducted in the 5-year period from the host country's NDC amount, right? So if there's a government change in the middle and they don't do this at the end of the 5-year period, then leaves you in a legal vacuum. You're saying, well, I got a 6.4 or 6.2 credit, I did not more, I used it, but they didn't correspondingly adjust it 4 years later. Where's the liability, right? Is that something that the private sector can take as a Corsia guy, that the regulator will come and say, you know what, the carbon credit you submitted in 2027, they just canceled it 3 years later. So where's your carbon credit? The market price is 5x higher.
Yeah, I mean, insurance can provide some level of solution, but that they risking, I think it's just overly complicated in terms of the design.
It's very complicated. Right? There's rescinding and the mechanism. Therefore, I'm saying this is something that it's very hard for private entities to take that risk, and this is where you have to have support from either development banks or governments in pioneering this and giving confidence to the market that this will work and how does it work, right? And I mean, they could do tenders for removal technologies. I don't see why the private sector would buy tons that you expect annually becoming cheaper.
Gradually cheaper.
That's a depreciating asset. Completely. Right? It's a good equity investment because adoption will go up, but the asset itself is depreciating. So that's not really scalable. Yes, it's a showcase thing. I buy 1,000 tons and 10,000 tons, but I'm not going to buy 1,000,000 tons of removal tons if I think I can get them cheaper next year. And that's not really helpful, but the government could do that.
Yeah.
And but ultimately, and I think this is really the key message, is that we should all ask ourselves, what's the ultimate metric of success? Right?
What is
the ultimate metric of success? Is there's less net emissions than before the market measure. And this is something that also the Guardian and others should ask themselves and saying, do they really achieve this metric of success where you say, people are everybody's doing their thing and nobody's going beyond? Is that more net emissions than if people go beyond an offsetting footprint, even with a couple of black sheep in there? But wouldn't that lead to more net reductions in the world if everybody would offset 100% instead of just 5%? I do think so.
And not only that, the alternative, the perverse incentive that they've actually effectively unlocked here is inaction is safer than action. And that's perverse. And we should call that out. It's a straw man argument that these guys are advocating. And it's because of an ideological slant against markets. But ultimately, I like what you said, right?
I mean, you have, in India, you have a registry called the Universal Carbon Registry, UCR. I don't know if you know it.
I know.
It's effectively a GoFundMe page.
Yeah.
Everybody can list a project. They explicitly say, our projects are not screened for additionality, for verification. You know, it's any project can list and say, this is what we do. Do you want to buy a ton from us? You know, and there's basically no liability. You can go as a funder and say, you know what, I like this project, Skogshof project or Waterfield, whatever. I'm just going to give you money and I get a donation receipt without all the fuss. And you're better off than somebody who actually qualifies the quality of what you funded. And then somebody says, oh, but it only reduced 0.9 tons, not 1 ton. You're a bad, bad boy. You know, you say, well, it's funny that the less sophisticated instruments, the GoFundMe page, is actually safer, exactly what you said, than going
But it's
into
not scalable because it's philanthropic as opposed to market driven. And so I think it remains niche.
Absolutely, it's total niche. Yeah, but I'm saying it's safer. You know, and people.
Yeah, but that's
you know,
logical to me.
it totally doesn't make sense.
Yeah.
Right? We should trust that you have to improve the system. This is kind of the conclusion where, you know, where you say offsetting is not good, therefore offsets are not good.
No.
That's the wrong conclusion. Saying offsetting is, you know, if you're using excuses is not good, but the other one is good, so let's improve the system and let's constantly improve it. It's a bit like saying the iPhone 1 wasn't really good, let's improve the versions.
Great analogy. No, I spoke with Tommy Ricketts from B0 2 days ago, just losing track of time and lack of sleep. But we talked about this with sort of their proposal for risk adjustment, essentially in portfolios, right? It's out for public comment right now, but it's essentially, as you said, okay, his adage was, all carbon credits are issued as 1 ton, but at the point of retirement, they may not be. It may be 0.9, it may be 1.2, depending on the baseline, depending on a number of other factors. But at a project-specific level, it's very difficult. But on a portfolio basis, you can adjust for that. So you can structure portfolios that compensate for these deficits or the gains, right, above that baseline. And so not only can you build out, can you ameliorate that kind of that carbon claim risk, but you can actually also benefit from having a diverse portfolio of different project types with different benefits associated with them, right? So that's a much more sound and more mature approach, right? That this market has sorely been lacking, and as a fund manager, you're bringing that type of rigor to the market right now. And I think that's what's scalable, because we see that in other financial markets. We see that other asset classes scale because of this. That risk is always there, right? You just have to adjust for it. So that's really.
I mean, but then you go into how much do you adjust, right? So
sure,
it's also tricky. But I think you have to just accept to some point that if you do an adjustment beyond your statistical deviation, it's a little bit like YouGov poll and say, 35% of Americans think X, and then there's a little disclaimer saying, plus minus 4% error margin. If you have something like this in the carbon credit, well, then I just kind of buy 80% or buy, let's say, 120% of the volume I need, and that should be fine. In a way.
I think but that's actually a pragmatic approach, right? I think that's what's being advocated right now in certain circles, which is, and I think that's where it will end up being, that there should be that buffer that doesn't just exist as the buffer at the standard, but a buffer on your, like a reserve buffer, effectively, for any potential adverse events, and then you can draw down from that buffer. If you don't, then you just carry that forward for next year, and so on and so forth. It's really not that much significant more cost, but it solves the problem of the confidence in the market, right? Because that's what's paralyzing the demand side right now.
If you can build 3,000 kilometer pipelines to physically transport oil from Russia to Europe, that's a problem you should be able to solve in order to unlock.
It's not rocket science.
It's really not rocket science.
Cool.
And so it's really, I don't think it's an inevitability that something needs to happen. I think otherwise we wouldn't be here to discuss all the stuff. And then there's a clock ticking for 2030. And at least in Europe and probably in other legislations as well, I think, Europe is interesting because the regulator now says, the Sustainable Reporting Directive, they're saying, just asking, what are you guys doing? Just asking, right? And you have to report what's your progress, what do you claim to do, what kind of carbon credits do you intend to use and everything. So it's just a matter of time until they have enough data and saying, you know what,
This
you're
falls
way
under our
off
purview.
target.
Yeah.
What do you intend to do about it? I can't see the European regulators
That's
saying,
your stick again, coming back.
nice, and that's your stick, right? But this is right now, that I talked to quite a number of companies, nobody has kind of a risk allocation and saying, you know what, we have to provision carbon credits of some sort because we have a problem here, right? And what I see is that eventually if the regulator over the next 3-4 years, and they have to do, they can't do this in 29, so they have to do this in 26, 27, the latest. If they come up and say, here's a white list of carbon credits that are eligible, by the way, you're on the hook for your claims, there'll be a crazy run on carbon credits. Because everybody says we need to hedge, and suddenly they wake up. It's a little bit like if you remember the MSR that came out 2016, nothing was happening in the market, flatlined, and then
the policy shift came, and then boom,
10x.
And I think
right?
that your timing and your crystal ball is absolutely correct.
Right?
I think you're right on. And the forward curve doesn't really show that right now on the futures contracts, but I think things are changing.
And therefore, also from a market perspective, if you are
so for any corporates listening, heed this man's words, right? Inaction is not going to continue. You can't keep kicking that can down the road forever.
No,
this time right now, it may be the case, but in 24, 25, and then 26, or whenever that time it might be before then, the market, like you said, there is a big run on it. Now, how do you hedge for that risk? Because you have compliance coming. It's like you're coming at very fast speed towards a brick wall. You need to pump the brakes right now, and you need to hedge for that.
Well, and
otherwise the price runs away from you.
How quickly do you think you can create carbon credits if demand is suddenly 50 million tons up?
I don't get me wrong on that one, but I just think
it takes you 3-4 years.
It takes you 3-4 years at best. But you have also, that's just on the ground. You have also inefficiencies baked into the system, and because of the scrutiny on standards, the independent standard bodies, not to mention at the 6.4 level. The processes are incredibly slow and robust. And so the throughput is incredibly slow. So if you were to turn on that ramp, you would consume all of the
How long does it take to put on this ramp?
It's very, very slow. They're working through, the industry at large is working through digital MRV tools in order to help to provide higher throughput and acceleration of that supply. But I don't think that will actually be as reactive as it needs to be right now. And then I think your prognostication is going to be proven to be correct.
And
that there will be a short.
How long does it take to create demand? It's a budget decision. On a corporate level, it's a couple of meetings, 6-month considerations, what SBTi requirements say, let's do it. Let's allocate $20 million for carbon credits. That can be done relatively quickly. To create the corresponding amount of $20 worth of carbon credits takes 4 years. So if you have switched on this demand at the same time because there's a EU signal or whatever other signal, there's going to be a period of scarcity. And if you look at the numbers, just high level.
Volatility. So markets gap. They go a little bit and then gap up, and then they find a level, and then they gap again, and maybe they go down, but they go up again.
And if you look at the fundamental levels, it's such a tiny market right now. And you have experience with Delta, but right now, let's just say, roughly speaking, 300 million tons supply per year. You have a couple of big guys, Shell, Total, Delta, a few people pulling out, and suddenly it's 50 million tons under demand. The market is out of whack, there's oversupply, prices tank. But that also tells you 4 or 5 big players coming in, 50 million tons over demand, suddenly the market is all of whack the other way, but it takes 3-4 years to balance it.
I want to reiterate that. It's so important. Think of it
fast.
Like the bathtub, right? And then eureka, get in, displacement. The market right now is in terms of oversupply. There's this kind of pervasive kind of view that it's oversupplied. It is not. With the core carbon principles even further, they will inevitably draw a line in the sand and restrict certain level of supply. So that supply quotient effectively goes to zero. Okay, wherever that line is, to be on the right side in terms of integrity, and that's good. We need that for the positive kind of long-term curve. If, like you said, these are outliers, you named only but a few. Let's throw Volkswagen in there as well. Okay, great. If you look at from a sector perspective, that's a very poor representation. These are outliers, right? Taking action and doing it at scale. What about if the other cohort starts to come
100%.
Now there's 1 and 2, 3 and 4, but then corporates go in herds, right? And now they're all rushing at the same time. There's this displacement. The market gaps violently up,
100%.
and the supply does not respond elastically.
And what do you think is the probability of this happening?
Is that
0%? Is that 5%, 10%? I think it's a good 20 to 40% at this stage.
Depending on timing. So if you ask me on 2024, 25,
Yeah.
or 26, I'm much higher in 26 and 27 because that 2030 wall is coming, and I don't think you can delay any further. I've seen so much positive action coming from this COP, and I've been incredibly surprised and overall, really just buoyed by the positivity of the commitments that are being made in a petro state, might we add. But I think that 2030, when we're sitting here, or for the next crop, where that it might be in 2030, those commitments will be implemented, right?
Yeah.
There will be that stick in place because it can't be rhetoric anymore.
And I think, the important thing is what you said also on the time horizon is I think it's the psychology of the people in charge.
Yeah.
If you're a trader, you think about your bonus next year.
Yeah.
So would I buy carbon credits this year to get a bonus next year? I don't think so because it's unforeseeable. It might or might not happen. As a risk manager, I have to look beyond 1 year, obviously, right?
Yeah.
Because I have M&A transactions going on. I have new plans, carbon intensity, regulations. So I have to think a couple of years ahead and plan ahead, also budget-wise.
Budget-wise,
right?
yeah.
So, and I don't see that happening. And they say, okay, we are short carbon credits. We don't know exactly what's eligible, but the probability of something happening is bigger than zero. How do I at least allocate some money for this, right? And if I was an investor, I would also say, hey, where's your reserve? Because if you were, let's just assume you are 1 to 2 million tons short. You don't know how much you get down in terms of physical reduction, 1 to 2 million tons short. And the carbon price could be anywhere between 10 and 100.
10 and 100.
That means your liability is somewhere between 10 million and $200 million.
Yeah, plan for that on a budget.
And how do they say, okay, it's 80% risk adjustment. That's still a big amount of reserves you want to have and calculate the flight in, and anyway, so I think
we can keep talking forever. This is why you're one of my heroes.
As an investor, which we are, if you have a longer term view and a bit of patient capital, it's a fantastic time to get into this market.
Yeah.
Because it's in my perspective, the really good project is undervalued.
Yeah.
The art is how do you pick the right projects? We have our own secret sauce how to do that. But I think it's really a shame because there is no real oversupply. We need more oversupply. We need all the supply in the world. We have only under demand. And that needs to change. So I think we have to tackle it much more on a demand side that will unlock the supply than a supply side problem.
Benedikt, we could keep going for hours, but I'm conscious of your time. I know you've got other meetings coming up, but hey, thank you. It's been a privilege. I would love to catch up with you once again and just continue to wax lyrical on carbon markets. So thank you so much. If you don't follow this man on LinkedIn, you're missing out here. It's incredible. Please follow him. So thank you so much, Benedikt. No, thank you again.
I
Appreciate it.
Thank you.
Thank you, sir.